Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. Thank you for joining us today. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. We're independent. We are a registered investment advisory firm. And yes, we are a fiduciary. I think the job of any advisor is to make sure when you are providing professional financial advice is to craft portfolios that are forward-looking, that are at the cutting edge of risk management, and can make money in all markets, whether the markets are up, down, or sideways. And you know that we do that. So we are headquartered in Chicago. If you're listening to the show, however, we can work with you. We do run the show in multiple markets. We're very, very proud of that as well. And we continue to look to expand. So if you would like to have an initial conversation with myself, you can give Paige a call. Paige is our assistant. She is phenomenal, much more than just an assistant. If clients are listening, you know that Paige is really great to work with. So if you would like to have an initial conversation, Zoom, meeting, what have you, give Paige a call, 630-492-1912, 630-492-1912. Well, volatility is back. Obviously, last Monday was a pretty interesting day. Then we had the markets recovered. But I think it reminded individuals that volatility happens fast, and you need to make sure that you are protected from it. We like to believe that we are pioneers in the risk management business. We are pioneers in utilizing strategies that most advisors don't use. If you've listened to the show, you know we believe in bank notes, and for our safe money, bank notes have been very, very predefined, predictable source of returns. We did do 3 bank notes actually last week, and those notes range from 10% to 12% for one and 12.5% for another. And those notes have downside protection, so the easiest way to look at it is you have 30% protection to get that annual coupon payment. So if it's 12%, you get 1% a month as long as the indexes it is tracking are not down. Obviously, given the risk, given the stress, given the market, given valuations, given unemployment, given inflation, given the upcoming election, many individuals are looking for places to hide out. And we have been utilizing these strategies since the early 2000s. When we started using them, you actually needed a minimum investment per note of $1 million, which is why most advisors did not use them. And today, the minimum investment is $1,000. I'm often asked by listeners and those that hire us to manage their money, why do not every advisor utilize these strategies? And it's very simple, very, very simple. Sometimes it's just is what it is. And if an advisor doesn't start to use something while they are building their business, building their book of business, building their clientele, generally speaking, they're not going to make and increase their workload. And that is simply why they don't use them. We have used these for years. They are labor intensive on our part, but they're a phenomenal strategy. Think about that. What strategy do you have in your portfolio that if the indexes were down 30% or less, that you would still make money? If you don't have those, let's talk. 630-492-1912, 630-492-1912. Headlines, when volatility picks up, obviously headlines really increase. JP Morgan now sees a 35% that the economy tips into a recession by the end of the year. That is up from 25% as of the start of last month. Again, it's simple. Risk happens. Risk happens fast. And you look at the markets, and again, I listen to other radio shows, and what we are selling, our value proposition is education. Our value proposition is education to allow you to include strategies in your portfolio, hopefully with us, but if not with us, that's okay as well, that can do well when the markets are down. I know I repeat myself, but that's the job of an advisor. Let the up markets take care of themselves. Have strategies that can preserve principal, have strategies in down markets, have strategies that can still generate positive returns in down markets. Those strategies exist. Allow us to educate you on the pros and cons, because the market in 2020, again, peak to trough, the markets crashed 35%. In 2008, peak to trough, the markets crashed 55%. In 87, 35%. 73, 50%. 1929, 90%. But each and every time it did recover. So I want you to think about that. It does recover. So you have to make sure you do not let the short-term fear control your decisions. However, there's a big but to that, okay? There's a huge but to that. Every loss that you incur, you need to use future gains to recoup those losses before you actually start to compound your money. So I have to stress to you that yes, markets long-term make money. However, if you had bought Microsoft in 2000, it took you 12 years to just get back to even. Think about that. 12 years just to get back to even. So if you bought Microsoft in 2000, that's 12 years of money that you did not see any growth on. Or another statistic, if you invested $10,000 in Ford 25 years ago, $10,000 in Ford 25 years ago, you now have $8,014. Again, today, dividends included. How terrible is that? So for those people that think that it's okay to just buy and hold the market, never make any changes, unfortunately, you're missing out. And I'm here to tell you, it is my belief, just based on people that I know in the industry, that advisors are managing their personal money significantly different than they're managing and advising on client money. I want to say that again. Advisors are managing their personal money, their immediate family money, differently than they are advising clients to manage their money. And it's an issue. It's a huge, huge issue, and we're going to be at the forefront of making this change. I mean, that's just the way that we are. We want to be very cutting edge. We want to make sure that we have our clients' strategies, that we are giving the clients the same opportunity that the institutions are doing. Because if you look at last Monday, would it surprise you to know that institutionally, they were net buyers? Think about that. Institutionally, when the market was down 1,200%, they were net buyers. Yet retail, individual investors, were net sellers. Think about that. Individuals were net sellers. That's why the institutions generally outperform. You always have to have a hedge in place. If you're not aggressive, you are not going to make money. And if you are not defensive, you are not going to keep that money. I want to read that again. If you are not aggressive, you are not going to make money. And if you are not defensive, you are not going to keep that money. Everything we talk about on the radio show is about what is the defense inside of your portfolio. And unfortunately, most individuals don't have it. Not because you don't want it, it's because the advisors are lazy. The advisors are using a strategy as in fixed income. Look at what's happened in fixed income over the last 4 years. So it's an issue. And our job is to make sure, again, that we're making money, preserving principal in down market. 630-492-1912. And I want to thank everybody for reaching out. It's just so phenomenal. Those that reach out generally have high level of intent of working together. I hear oftentimes, I've listened to you for an extended period of time. I just now decided to reach out. And I guess my job is to try to shorten that time. It's not self-serving in any way. Certainly, yes, you could become a client faster, which, I mean, is obviously a good thing, right, for us. But more importantly, it could be a good thing for you because we could limit the potential loss that you are experiencing. Because if we look at what JP Morgan said, 35% chance the economy tilts into a recession by year end. That is an issue. We have to rethink the rate cut playbook. And I think so much of what is going on today is based upon what we think the Fed is going to do. We still have high inflation. We still have record inflation. Now, they may tell you we don't, but last time I checked, everything costs more. So I don't know what they're looking at, but everything costs more. But Wall Street is betting that at the next Fed meeting in September, there's going to be a rate cut. And if you look at investment strategies that have worked ahead of past Fed rate cuts, they may not be as effective this time around. And so we're hearing a lot of individuals question and ask us, how should we position their portfolios? Now, we believe in four things: protected growth, we believe in growth plus, and then we believe in tax alternative strategies that can greatly reduce your taxable income, strategies that can generate returns independent of the stock and bond market. Because if you look at the difference, you look at just your traditional family office and you look at those asset allocations, they're significantly different than the average investor. And if you have listened to the show, we work with investors who have a couple $100,000 and we work with investors who have $50-60 million. So the amount of money that you have is not something that we look at. Now, the strategies will change, of course. What we look at is, does an investor have a willingness to think differently? Does an investor have a willingness not to lose money when the markets are down? Does an investor have a willingness to invest in strategies that can deliver positive returns for some of their money, even when the markets are negative? That's what we look at. So we're really thinking about the rate cut playbook. The likelihood of an economic soft landing instead of a recession, it's still there. I don't know what, those probabilities are, because probabilities are just, guesses, but we have to make sure that, the markets are now fully expecting the Federal Reserve to begin lowering interest rates in September. And many investors, certainly, the ones that we are talking, are asking, will the traditional rate cut playbook continue working? And if you look at what has worked historically when the Federal Reserve has appeared to be on the verge of bringing interest rates down, many investors have they've increased their exposure to long duration bonds and certain stock categories like small cap cyclicals, value oriented equities, while bidding up economically sensitive cyclical names. And the markets generally will follow a script. In July, after cooling inflation data boosted investors' confidence that the Fed could, again, we have to, I keep saying they could take action soon. There really was a market rotation from the so-called Mag 7, which we've talked about over and over again on the radio show, but from the Mag 7 mega tech stocks, they have dominated large cap equity indices, to those seen as rate sensitive type equities, including cyclicals and small caps. And we have to make sure, again, when we're looking at managing money, and we're going to talk a lot about this today, managing money and asset allocation is the most overused phrase in investing. If you ask your advisor, how am I managing risk? They're going to say diversification, asset allocation. Okay, well, explain that to me. Show me a bucket of my money that will actually preserve principal or make money when the markets are down. And if they cannot do that, if you cannot see a 5%, 50%, 70%, 30%, whatever, if you don't have a strategy that's predetermined, like the banknotes we use, 12%, as long as the indices don't drop 30, you get paid your 1% a month coupon. If you do not have that, please think ahead. Please be proactive. We need to have that strategy in place. Simple math. If we lose less, ultimately we'll make more. We'll finish up the rate cut playbook after the break. My name is Robert Kuhn. I'm the host of this radio show, Destination Retirement. If you have any investment-related questions, please feel free to give me a call. You can set our initial consultation up. It's a simple conversation with Paige, 630-492-1912, 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president, founder of Kuhn Capital Partners, independent fiduciary, registered investment advisory firm. We are headquartered here in Naperville, just outside of Chicago. If you are listening to the show, understand that we can work with you. We do have a national client base, so we'd love to work with individuals outside of our immediate area. We thank you for joining us this weekend. If you have any investment-related questions, if you want to learn how to make money when the markets are down, if you'd like to learn how to add strategies that can preserve principal when the markets are down, give us a call, 630-492-1912, 630-492-1912. So we're talking about the playbook of interest rates. And like everything currently in today's market, the playbooks are very, very unique because we're experiencing things that we just haven't really gone through before. And I want our motto, again, something that we're going to talk an awful lot about throughout the end of summer and then into fall and then into winter, is if you're not aggressive, you're not going to make money. And if you're not defensive, you are not going to keep that money. Unfortunately, advisors very rarely will do both. They're either really good at protecting or they're really good at growing. If you grow, you have a lot of volatility. If you protect, you're really not getting any growth. So if you're not aggressive, you're not going to make money. And if you're not defensive, you're not going to keep that money. And that is the job of an advisor. The job of an advisor is to make sure that we have strategies in place that can make money when the markets are down. Simple math. Lose less, ultimately make more. So, we've seen a little bit of the markets move darken, I think, over the prospects of a economic slowing. If you look at many of the global investment banks that we follow, we still believe in soft landing, which means growth cools but does not collapse. And I think that is something that we have to hope for. But going into an election, an election period, especially in one as contested, as heated as this, the valuations of the market, nothing would surprise me. To see a 20% correction, it wouldn't surprise me. And if you can, a 30% correction wouldn't surprise me. And if you're not 100% convinced that your portfolio could benefit and even preserve principal or even make money in that market, those are the individuals that we want to talk to. So I think higher rates may weigh on bonds. The traditional playbook, if you go into a recession, it really is to anticipate steep declines in short-term yields, and investors oftentimes will shift money to longer duration bonds to kind of lock in current higher yields and potentially benefit from a rise in the bond prices as rates fall. We're not sure that that's going to happen. This time it could be different, and those are four very expensive words. This time is different, especially when it comes to investing. But if you look at interest rates and if you look at fixed income, generally advisors have used fixed income as a means of portfolio diversification. We have been in the worst 4-year drawdown in the bond market. So if you're working with an advisor that is still only managing risk, which I bet you 99% of individuals listening today, the only risk management you have in your portfolio have been bonds. Well, you've lost money in that bond space. And so we have to, again, look at things differently. That's when you know you're working with a good advisor. A good advisor uses cutting edge strategies. The bank notes, for example, they're not, once we own it, they're not interest rate sensitive. So we know the day that we own the note what our coupon is. We know what our downside is, so we know what we're going to get paid if it doesn't breach that downside. And generally speaking, we're in that 12% range with 30% downside protection. That appeals to a lot of individuals that are listening to this show. You could get 12% a year for your safe money as long as the indices don't go down 30%, and those are paid 1% a month. So whatever the annual coupon payment is, those are paid monthly. So you have to make sure that, again, we're just looking at the world differently because, the traditional playbook, again, if we look at cyclical stocks, for example, they should stabilize. Traditionally, often when a recession appears on the horizon, investors expect plummeting rates to support the prices of economically sensitive or cyclical equities, even as faltering growth pressures their earnings. This can cause their price to earnings multiples to expand. Again, that may not happen this time. And so those are things that we have to look at. And, small caps remain vulnerable. Again, the traditional playbook is seeing attractive relative valuations. Investors have been buying up smaller stocks ahead of expected rate cuts, anticipating that lower borrowing costs may actually benefit these businesses in particular. That may not be the case. I've seen calls for growth in the small cap space upwards of 20 to 30 to 40%. What happens if that doesn't happen? And if you're overloading, your portfolio to the traditional playbook when interest rates are going to be potentially cut or recession is on the horizon, every playbook, every situation is different, especially in this market. And that's one of the reasons why when you look at asset allocation and you look at diversification, I'm here to tell you that you're probably nowhere near diversified as you think. You may own 50 ETFs, 50 stocks, 50 mutual funds, whatever. You may own a lot of things, but that doesn't mean you're diversified. What that means is you own a ton of equities and you've got some fixed income. And my question to you is, what happens to your portfolio when the markets drop 30%? What happens? And if your advisor can't answer that question, or if they say, well, it's time in the market, not timing the market, you owe it yourself to get a second opinion. 630-492-1912, 630-492-1912. We'd love to share our thoughts, our portfolio construction abilities, our financial planning capabilities, and we'd love to just share with you what we're doing. After this segment, we're going to talk about the top 5 mistakes investors make when markets become volatile, but we've got a couple minutes left here that I want to go over tax strategies, tax reduction. Here's the deal. If you're working with a big bank, if you're working with a big brokerage firm, chances are you don't have, or you have very, very limited tax strategies. I mean, you've got maybe some real estate. If you own it outside, you have, a little bit of tax benefits there. Again, if you're working with a big brokerage firm or a big bank, there may be some tax loss harvesting, trying to match losses with gains. I don't even know if that constitutes tax strategies anymore. The benefit of being independent, the benefit of being an independent fiduciary is we have options that most individual advisors, if they're working with a big bank or if they're working with a big brokerage firm, simply do not offer their advisors to bring to their clients. That's just the way the industry is. And their technology is, my gosh, so dated. But that's another rabbit hole we can go down. So as an independent fiduciary, independent registered investment advisory firm, our opportunity, our access to strategies is significantly greater than those advisors at big banks and big brokerage firms. You have to understand that. So when we look at tax strategies, we are talking about strategies that can greatly reduce your taxable income, not only your active income, your passive income, 1099 income, W-2 income. Our energy strategy that we utilize last year, had you invested $100,000, you were able to reduce your taxable income by almost $90,000. So think about that. Invest $100,000. You were able to reduce your taxable income by $90,000, almost. Now, best practice, we can't provide tax advice. We're not CPAs, we're not accountants, etc. Best advice is always to, best practice, speak with a tax accountant, speak with somebody who does your taxes, get their professional opinion. I want to make sure I clarify that. But in the energy space, these tax strategies are very, very black and white. Here in the Midwest, they're just not used often. Down south, Texas, New Mexico, Colorado, used all the time. Here in the Midwest, you just don't have a lot of advisors that have had experience in the energy space. So when you look at energy investing, think about it. If you sold a business, if you sold a building, if you have concentrated stock positions, if you are exercising stock options, if you are a high wage earner, tax reduction should be at the forefront of what you decide or what you're looking for in working with an advisor. If you're interviewing an advisor, if you currently are working with an advisor, a simple question is, how can I greatly reduce my taxable income? And just see what they say. Probably going to talk about munis or tax-free investments. No, I'm talking about how can I reduce my taxable income dramatically, to the tune of, if I invested $100,000 in the KCP Energy Fund last year, you were able to reduce your taxable income, active, passive, 1099, W-2, by almost $90,000 in an investment that has targeted distributions that are not dependent upon the stock market in the 15 to 20% range. Now, past performance isn't indicative of future results. We have to go over risks. We have to go over what the investment is. I'm not saying that it's there, it's appropriate for everybody. But again, if you look at what the family offices are doing, their asset allocation for their clients is generally 40 to 45% private equity. Think about that. Private equity. Most individuals who are working with a bank or a brokerage firm, or if you're managing the money on your own, you have no exposure to private equity. You have no alternatives inside of your portfolio. So that's why you're tracking the market up, tracking the market down. We have to incorporate, again, a piece of our pie, how we manage money, protected growth plus, alternative/tax reduction. If you're a high wage earner, if you're a physician, if you're an attorney, if you make, $500, $700, million, $2 million, $5 million a year, if you sold a business, if you've had a liquidity of some sort, if you sold real estate, if you're stock options and you're exercising those and you have significant capital gains, you have to reduce that taxable income. And in the energy space, I do not know of any better tax benefits. Last year, had you invested KCP Energy Fund, you were able to reduce your taxable income, active or passive, 1099 or W-2, by almost $90,000 and own an asset that has targeted distributions in the 15 to 20% range. So if you want to have a conversation about that, let's certainly do it. We love talking about that. Again, it's not what you make, it's what you keep. And the most overlooked area of financial planning is tax strategies. If you're working with a big bank, if you're working with a big brokerage firm, and you're in that, kind of that $500,000 to $10 million net worth range, you do not have access to these strategies. So we have to talk about how we can greatly reduce your taxable income, allow you to keep more, and then have some distributions that are not dependent upon the stock and bond market. 630-492-1912 if you'd like to start that conversation. 630-492-1912. Also, we're going to have a dinner in Naperville at Morton's on August 27th and 28th just for this strategy. $1 million net worth is required, not including your home. So $1 million net worth, not including your home, or make, I think it's 300,000 single, 400,000 joint. Just look for accredited investor status. And if you meet that, then we'd love to welcome you at the dinner. The dinner will fill up almost immediately. So we are probably looking for additional lunches during those days as well. 630-492-1912 if you'd like to learn more about that. Let's have a conversation. After we get back, we're going to talk about the top 5 mistakes investors make in volatile markets. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent fiduciary, registered investment advisory. Our job is to craft portfolios that have the ability to deliver positive returns in up markets. There is a distinctly different way that individual advisors manage money, in my opinion, their own money, than the advice and how they manage clients' money. And we're here to be a pioneer of changing that. We want you to have the same strategies in place that can make money when the markets are down. Those strategies take education. Those strategies take some time to understand. But we're here to do that, and we want to do that with individuals who want to have the ability to protect principal in down markets and also see positive returns in down markets to a certain point. Again, if you are not aggressive, you are not going to make money. And if you are not defensive, you are not going to keep that money. You have to do both, and that's what we're very, very good at. In addition to financial planning, income management, tax reduction, etc. So if you'd like to have an initial conversation with myself, we can do that over Zoom. We could do a conference call. We could do a telephone call. We could do an in-person meeting. We are headquartered in Chicago, Naperville, suburban Chicago. If you're working or listening rather to this show outside of the Chicago market, understand that we are here to help you. We do run this show in multiple markets, and we're looking to continue to expand that reach. 630-492-1912, 630-492-1912. If you'd like to get on our calendar, please do so by calling 630-492-1912. Paige will set that up. Last segment, we talked about tax reduction. Again, if you want to greatly reduce your taxable income, strategies exist. KCP Energy Fund last year reduced your taxable income by almost $90,000 per $100,000 invested. And it was in the energy space with targeted annual distributions in the 15 to 20% range. If that makes sense, if that is something that you want to learn more about, how to greatly reduce your taxable income, give us a call as well. I did mention last segment we are having a dinner to go over tax reduction strategies at Morton's in Naperville on October 27th and 28th. The only criteria to attend those dinners, just because the strategy is required, you have to have be accredited investor. Accredited investor is $1 million net worth or more, not including your home, or certain income requirements. I think it's $300,000 single, $400,000 joint. If you meet that criteria and you want to learn how to greatly reduce your taxable income, active, passive, 1099 W-2, give Paige a call, set up that initial conversation with myself so I can tell you what the dinner is and what it's going to be about so you're not wasting your time. 630-492-1912. Okay, top 5 mistakes investors make in volatile markets. We were thinking about this a lot, given what happened on Monday when the markets cratered and what happened overseas in Japan. And now the markets have come back. But most individuals think that we're going to see unusual volatility. That's our gut. That's our gut. Now, our guess, that's what we think is going to happen. Now, that being said, my gut feel is irrelevant. The markets don't care about what I think. So when we have to craft portfolios, we want to make sure we've got some money that can preserve down markets, that can preserve in markets that we don't expect. Because whether it's panic selling, hiding out in cash, or trading frantically during volatile markets, investors tend to make several mistakes that can hurt their long-term growth. And I think knowing how to spot and avoid those common mistakes and bad behaviors can only help you. And we look at the markets, and we look at, as I mentioned in the first segment, Monday when we saw the markets drop over 1,000 points, institutions were net buyers, retail were net sellers, and I put that squarely on the shoulders of advisors. Everything that I talk about on the show, unless you're managing the money yourself, well then you have to look in the mirror. I mean, the buck ultimately stops with you. But I am coming down on advisors. I am coming down on the fact that advisors craft and manage money in a way that is scalable for them to build a bigger business to then generate more revenue for themselves and their family, not how they're managing their own money. And we are on a mission to change that. We are proactive. We are cutting edge. We are at the forefront of bringing institutional-based strategies that can deliver principal protection, the ability to make money when the markets are down, to you. Most people will say, don't ever talk about those strategies on the radio. They're too confusing. Don't talk about those strategies at dinners. I'm like, why? Well, consultants will tell me, well, your only job on the radio or at the dinners is get them in the meeting, get them in the office, get them to pick up the phone. It's like, no, I have a good business. I want to grow it, of course. Who doesn't want to grow their business, right? But we have great clients. We have a great clientele. We have a very mature business. It affords me the option to talk about things that other advisors aren't talking to you about. Things that I talk to you about are things that I talk to myself about, that I talk to my sons about, that I talk to my immediate family about, that I talk to close friends about. Strategies that we use, we're going to use for everybody. And again, a lot of it kind of falls on deaf ears until we have volatility kick back, until volatility starts. And I think if there's one thing we know is going to happen, well, at least I believe, is that we're going to see volatility. Another thing I know is mathematically, if you lose less, you don't have to use future gains to get back to where you were. You can use those future gains to compound your money faster. Isn't that the job of an advisor? Compound your money? So don't buy into this. Well, you have to, you can't time the market. You got to sit and take it. It's okay to lose 30%. You don't need the money today. It's like, okay, well, if I lose 25%, then the next 30% is just going to be used to get me back to where I once was. Well, what if we could mitigate that? What if we could not lose that money and then really use those gains to grow and compound our money? So I think in times of market turbulence, staying invested certainly is what everybody's going to tell you. And sticking with a thoughtful, goals-based financial plan can lead to better outcome. Doesn't that sound so fancy? Well, the markets are down 20%, but we're going to stick with a thoughtful, goals-based financial plan so it'll lead to a better outcome. Who cares what a financial plan says? I mean, yes, I want to take a step back. All my financial planning buddies are going to come and scream at me. I believe in a plan. I believe in a financial plan. I'd never get on an airplane if they didn't have a documented flight plan that, where we're going to go from A to B, and here's how we're going to get there. I get it. We need the plan. But I see too many people use a financial plan as an excuse to be okay with losing money. It's not, and it's the advisor. The advisor is going to say, don't worry about it. We're down 25%, but the plan says we're going to be okay. I want to see what they're doing with their own money. I want to see if they're going to have that sit and take it feature with their own money. And chances are that that's not going to be how they're managing their own money. So then why is it good enough to manage other people's money a different way than they manage their own? Well, here's the answer. The business is scalable. They can manage more money. They can manage more clients. They can increase their revenue. And they know that most clients, until they meet with an advisory firm like ours, 99% of advisors are going to say the same exact thing with a little different spin on it, little different, better marketing, nicer logo, better office, better phrases. It's all gobbledygook. The question is really simple. Ask an advisor, show me the bucket of my money that will make money if the markets are down. Show me the bucket of my money that will preserve principal if the markets are down. And if you can't do it, you got to reach out. 630-492-1912, 630-492-1912. Because as troubling as market sell-offs can be, and they are, at least one feature often feels familiar to me. It's the effort to convince investors to avoid the seriousness of making quick decisions. Short-term thinking, generally speaking, is not going to be a good outcome. So here's the deal. Rather than me having to convince you that it's okay to lose 20% and pull out a financial plan that says, hey, it's okay if you lose 25% because in 10 years you're going to have X. Well, what if, here's a simplistic thought, what if we could make money when the markets are down with some of our money? What if we could preserve principal when the markets are down? I mean, how basic is that, right? So I want to make sure that we're talking about the mistakes that I see in periods like we experienced last Monday. And number one, obviously, is panic selling. Yes, it can be gut-wrenching to see your investment portfolio or your 401k or your IRA that you've been building for years take a sudden dive. I get it. The urge to stop the bleeding can be overwhelming, especially if you're 10 years from retirement or in retirement. I get it. I get that. And it's kind of like, well, you know what? I have to salvage what I can. I'll wait till the dust settles, and then I'll re-engage. Well, isn't it Warren Buffett that says you want to be greedy when others are fearful and fearful when others are greedy? So I think selling into a falling market ensures that you lock in those losses. If you wait, it could take you years to get back to even. Again, consider that someone who stayed invested from 1980 until March of 2024. they would have annualized about a 12% rate of return. That's pretty darn strong, right? But does that mean that you just have to, just that statistic showing you that, does that now mean that you can't play defense? Does that mean that you have to stay fully invested? Does it mean that you can invest in strategies that can preserve principal and still grow? Or strategies that can actually make money when the market's down? I mean, so don't buy into that garbage that advisors are saying. I'm so tired of advisors saying you have to take the long view. Of course we have to take the long view. Doesn't that just go without saying? You need to take the long view. Does that mean that I shouldn't incorporate strategies that can make 12% a year as long as the indexes it tracks aren't down 30%? Does that mean that I shouldn't put it in a strategy that is principal protected and I get the first 11.5% of whatever the S&P growth is? So yeah, I get it. Investing is long term, but that doesn't mean that you just set it in equities and fixed income and then, let it do whatever it's going to do. And again, it is your money. So if you want to do that, I guess the question is, why are you working with an advisor? Why paying advisors fees if you're just going to do an asset allocated portfolio, buy and hold, and then look at it 10, 15, 20, 30 years from now? You don't need an advisor to do that. So I would, you don't want to panic sell, right? But that doesn't mean that you can't incorporate strategies that can do well when the markets are not going crazy like Monday. So a lot of times people go to cash and they stay there. I cannot tell you how many people that I've talked with over the last handful of years that have greatly underperformed the market because they've sit in cash and they've said the markets have to go down. Well, the markets don't have to do anything. And we're going to talk a lot about this in the next segment. And we're going to talk a lot about annuities in the next segment and lifetime income annuities and why so many people are disappointed with these lifetime guaranteed income annuities. So I'm going to talk about that a lot in the next segment as well. So stay tuned. We'll talk about cash. We'll talk about just making, bad decisions, especially, when it comes to the markets and going to cash and then staying there. Again, I've met with so many people who have greatly underperformed the market. And if you're 10 years from retirement, or if you're in retirement, those are mistakes that you just can't make. So 630-492-1912. That's how you get a hold of us. 630-492-1912. Give Paige a call. She will set up our initial consultation so we can just have a conversation on what you're doing, what you're worried about, what your concerns are, and we'll see if there's a mutual willingness for us to help you and for you to receive that help. So 630-492-1912. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. Happy Saturday morning. Hopefully everybody is having a great weekend. My name is Robert Kuhn. I come each and every week to bring you ideas, strategies, thoughts that can educate you, hopefully get you to think about the world a little differently when it comes to working with an advisor. Think about the world a little differently when you are making investment decisions, because if you're not aggressive, you are not going to make money. And if you're not defensive, you are not going to keep that money. Challenge is most advisors can't do both of those things correctly. That is an issue. That is what we see. Our job as a fiduciary, our job as an independent registered investment advisory firm is to make sure that we are crafting portfolios that can generate positive returns in all market scenarios. Now, it might not be for all of your money, but it could be for 30% of your money. It could be for 50% of your money. It could be for 70% of your money. That totally is individualized, but those strategies do exist. If you'd like to have an initial call, or if you've listened to the show and we've talked in the past, but we've lost contact, and now's the time for you to make some decisions, We'd love to have that conversation and share with you how we can help you, and really, more importantly, learn about what you're looking for. 630-492-1912, 630-492-1912. We'll have that initial 15 to 20-minute call or a Zoom or an in-person meeting. We are located in Naperville, just off of 59 and 88. So we are in the Chicagoland market. If you're listening to the show, we do run the show in multiple markets, so rest assured that we can work with you, and we look forward to working with you as well. So we talked a lot this show about tax reduction. I love it. I love being able to legally reduce taxable income. If you're a high wage earner, if you're a physician, attorney, somebody that makes $500,000, $2 million a year, if you have sold a building, if you've sold a business, if you've recently exercised a bunch of stock options, if you are retired and you want to take RMDs in a very tax efficient way, we have a strategy for you. It's the KCP Energy Fund. Last year, had you invested $100,000, you were able to reduce your taxable income by almost $90,000. Yes, $100,000, so just simple math. Certainly invest more than $100,000 if it meets your due diligence and you are comfortable with it. If you invested $1 million, you reduce your taxable income by almost $90,000. So you could do the math, almost $90,000 per $100,000 invested in a strategy that has targeted distributions in the range of 15 to 20% a year that are not dependent upon the stock and bond market. So 630-492-1912. If you want to learn about the energy strategy, we would love to have that conversation with you. We're talking about mistakes people make when there's volatile markets. Last week, the markets were down significantly on Monday. World was coming to an end. And then by the end of the week, no worries, we were just kidding. I get it. And we want our clients, I think if you ask the bulk of our clients, I believe they would be able to point to the strategies inside of their portfolio that would make money if the markets were down to a point, or would preserve principal if the markets were down at all. I believe that the bulk of every one of our clients could do that. If you cannot do that, if you're working with an advisor and you can't point to the bucket of your money that can generate positive returns to a point if the markets are negative, or preserve your principal, then you're not working with the right advisor. That is, it's simple, cold, hard facts. 630-492-1912 if you want to learn about those strategies. So panic selling, we don't want to do that. Stay in cash. Go to cash and stay in cash. Unfortunately, I can't tell you how many people have sat in cash and they've missed the market and they've missed the run. And I think a lot of that is because we have very conservative clients. Don't get me wrong. Very, very conservative clients in many instances. And when you look at a portfolio, if you know that you've got 50% or 60% or 70% of your portfolio, what have you, that is not going to be affected by the market on the downside, or could even make money as long as the markets aren't down, say 30%, which is generally the notes that we do offered by the largest banks in the world, you're okay with the other 30 to 40 to 50 that is going to go up and down. That, if you don't have that, that's where we see people go to cash. And the markets today are very momentum based. If you're still working with an advisor that manages money and talks to you about Morningstar style boxes, or owning small, mid, large, growth value, international, emerging markets, that is 1980s, that is 1990s. It's not today, in our opinion, at least I would never accept that. Money management today, with the evolution of computers, with the evolution of being able to use AI, the computers can see things the human eye can't, the human brain can't. And generally speaking, when you look at who is doing the best, it's momentum-based managers that don't care where the money is flowing. They're just following the money. It's simple economics. When money is coming in, prices go up. When money is going out, prices go down. It's really that way in anything, clothes, cars, real estate. That is the evolution of money management. Not trying to predict, not trying to guess, not trying to make excuses on why we lost money. Let's just follow the money, and the computers allow it. And now the strategy is it takes a lot of computing power to get there. It's not a perfect strategy. It's not going to work all the time. That's why most advisors don't want to use it, because it takes education. Well, we do, and we love it. And if you look at the momentum-based index versus the S&P, significant outperformance this year. So don't be in a position that you have to go to cash. That's the challenge. Third mistake that I see, so first two were panic selling. They go to cash and they stay there. Overconfidence and confirmation bias. Well, I see that all day long. It's human nature to want to feel right. Who wants to know they're going to make a wrong decision? It's hard to do. It's hard to look in the mirror and say, man, I really screwed up. And when it comes to investing, it's such a simple, investing is so simple. So simple. But it's not easy, right? And I have a 25-year, 26-year head start on you. And we have always been the advisory firm that is going to use cutting-edge risk management strategies that the high net worth use, strategies that the big banks use. Again, if you're not aggressive, you're not going to make money. And if you're not defensive, you're not going to keep that money. So we want to ingrain that thought into you. 630-492-1912, 630-492-1912 if we can help you out. Okay, guaranteed income annuities. I see them sold too many times. Way too much. Yes. Do I like to hear guaranteed income no matter what happens in the market? You're darn right. That's probably the best sleep at night strategy out there. I get it. Problem is, the advisors who's selling you those, they're not being honest. In many instances, they're not giving you both sides of the coin. They're just telling you one side. I want you to think about this. Again, we think that 9 out of 10 people who buy guaranteed lifetime income strategies don't need it. You can make more money somewhere else. You can take more distribution somewhere else. If an insurance company is going to guarantee guaranteed lifetime income, understand this. You're only taking your own money until the account goes to zero. Once the account goes to zero, if you were in mutual funds, your income stops. If you're in a guaranteed lifetime income annuity, the insurance company is going to pay you. Really simple question. You don't need to be a financial genius to understand this. Do you think the insurance companies actuarially are going to let that happen? Of course not. How do they not let that happen? They give you just enough growth to overcome some of your distribution, and then they limit how much money you could take out. That's it. So you're giving up, in my opinion, so much for that guaranteed lifetime income annuity, for that guaranteed sleep at night feature. Now, if you have a couple $100,000 to your name, that's all of your investable assets. It may be the single best investment out there for you, without a doubt. But if you have $500,000, $250,000, $500,000, $3 million, $5 million, $7 million, why is the question that I want to know. Why? Because the guaranteed lifetime income, you're only taking your own money out until the account goes to zero. Insurance companies are making sure that actuarially that is not going to happen. They're going to give you just enough growth to overcome a portion of your distribution, and then they're going to tell you how much money you can take out. They're going to put a governor on that withdrawal. Well, tell me how inflation is going to treat that withdrawal in 10 years. I'll wait. Not you. The advisor really is who I'm asking. Because you're taking $18,000 out today, and that's all they're going to guarantee, or $20,000 or $50,000, whatever that number is, and you've got another 10 years, 15 years, 20 years to where you need that money. How is that inflation going to affect that withdrawal? So you can't say, I often hear, well, you guys don't like annuities. No, absolutely not. We have the single best, in my opinion, index annuity that's a 5-year strategy. That's it. I mean, so you can't say I hate annuities. 5 years, 100% principal protected. You will not lose a penny. In any year the market's negative, your return is zero. You get the first 11.5% of the S&P growth annually. Today, that's the rate. So if the S&P's up 1, you get 1. 5, you get 5. 11.5, you get 11.5. The S&P's up 50, you get 11.5. Again, this is our safe money. So think about that. There's a lot of people listening today that will take the first 11.5% of the S&P with no downside. When you get that gain credited, you can never give that gain back, so you don't have to play that catch up. So think about that. Think about that strategy, and then think about using banknote strategies to derive income. Think about that. Think about if we could get 10% distribution strategies, 13% distribution strategies. So you can't say that we don't like annuities. I love the 5-year annuity. I just don't think. I think 9 out of 10 people who buy guaranteed lifetime income don't understand what they own. They don't understand that that 7% growth rate that they're going to guarantee, quote unquote, is not really growth on real money. It's for income. So if you own a lifetime income annuity, for being sold a lifetime income annuity, let's have a conversation. Please, let's have a conversation. I know the people on the radio that sell them, and they sell a heck of a lot of them. And you know what? They pay a nice commission. I'm here to tell you, if you have over $250,000 of investable assets, it's probably not for you. You're not going to get a benefit until that account goes to zero. Let's have that conversation. 630-492-1912. So hopefully everybody got something out of the show. I know I talk a lot about the same strategies. I have some people say, well, you repeat the same strategies. Well, that's just the way it is. And you know what? I appreciate you for listening. I appreciate you for recognizing that. But our job is to make sure that we're crafting portfolios that can generate positive returns regardless of markets for some of the money. Because again, if you're not aggressive, you're not going to grow the money. If you're not defensive, you're not going to keep the money. We need to be both. Again, thank you for listening. My name is Robert Kuhn. This is Destination Retirement. Give us a call this week if we can help you. 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this